In this session, we're going to talk about the company-sponsored pension plans, basically, and there are two of them, the two major ones that we'll look at, and there'll be some other sort of minor ones, but we'll look at them all, basically. So today we're going to look at defined benefit pension plan, or DPP, basically, so defined benefit pension plan. This is what they call the gold standard of pension plans. Okay, this is the best of the best, and therefore, as you'll see in a moment, this is the one that most employees want, essentially, okay? And the main reason why it's the gold standard is because the income is known in advance. In other words, you know that if you work for me to age 65, this is what you're going to get. Okay, it's predetermined, so you can do all your financial planning. You know that as long as you're working for me at age 65, when that day arrives and everything, this is going to be the check I've guaranteed you, let's say $4,000 a month for the rest of your life or something. So you know that. So when you know the amount of what your income is going to be, if you're asked on the exam or anything, if the client knows how much money they're going to receive as a pension, then what kind of a pension do they have? Well, the kind of pension they have is a defined benefit pension. In other words, very clearly defined. You already know what you're going to get, so there's no misunderstanding about it. So the only criteria here is you have to be with me until age 65, let's say, whatever that age. It could be even earlier, it could be age 60. It all depends on your plan sponsor, basically. Once you start getting that income, which is fully guaranteed and everything, okay, that income will continue on for lifetime. So this is a lifetime benefit pension plan. So therefore, if you live to 106, you get an income for until 106, basically. So it's a lifetime income. In many cases, should you pass away during that period of time, there is also a spousal benefit. And that spousal benefit, usually it's around 60%, just like Canada Pension Plan pays a spousal benefit of 60%. Very much in tune with this is what defined benefit pension plans tend to also pay out 60% to the deceased spouse as well. So there is a spousal benefit, okay? Many times, of course, the pension is also indexed, so it does try to keep up with inflation and everything. So you can see for all these four reasons why people favor this kind of a plan, because, like I said, you know exactly what you're going to get every single year for the rest of your life. Your spouse is going to be protected. So basically, life is beautiful, as they always say. However, you have to be eligible for it. Okay. In other words, how do you become eligible for this kind of thing? Okay. First of all, the eligibility requires that all employees are covered. In other words, in a defined benefit pension plan, you can't discriminate. Okay. So either everybody's got one or nobody's got one. So the plan sponsor, whoever it is that's sponsoring this, the company you're working for, can't say, okay, no, the executives will get this, but the rank and file will not get that. This is a plan that everybody will be entitled to. So the formula is the same, everything's the exact same thing. So we can't discriminate. So the first thing is all employees now. Full-time employees usually will qualify within 2 years of employment. Now, it could be earlier, but they must vest by 2 years. Okay, so under the provincial regulations and everything, pension plan regulations, is that a pension must vest no later than 2 years. It could vest immediately. Okay, it could be a situation where you could, in fact, take out the pension or start to contribute within a year of employment. Okay, but no longer than 2 years. After 2 years, it has to vest to you as well. If you're a part-time employee, then you do have to wait for that 24 months. And so it's very rare that you're going to get, as a part-timer, that you're going to get a pension contribution right away. Usually, you have to wait for 24 months, and then you can start contributing and everything else. Okay, or at the very least, you've worked 700 hours for your employer. Okay, so whichever comes first, you might say the 24 months or the 700 hours. Most of the time, 700 hours is comes first, anyways. Okay, but that's the general rule that you have to look at. Okay. In terms of the contributions, it all depends. Okay, there are two kinds. There's what they call a contributory pension plan and non-contributory pension plan. A contributory pension plan means the employer and the employee put in a certain amount of money, whatever that happens to be. So, for example, some employers will say for every dollar that the employee puts in, we will put in $3. For example, that kind of a pension. It could be 50-50. It really depends on the plan sponsor and how the whole thing is all designed and everything else. So in a contributory plan, it's a situation where both the employer and the employee contribute a certain amount depending on the agreement and everything. In a non-contributory plan, the employer pays everything. So generally speaking, unionized employees, for example, tend to be more non-contributory in that the company pays for everything. Non-unionized tends to be more of a 50-50 type of split. But that's what you've got, essentially, okay? Also, because it is a defined benefit pension plan, you can also buy past service. Okay, so for example, let's say that you never participated in the pension plan at all. Okay, so you're a new employee, or maybe the plan never had any kind of pension. The company never had a pension before, but you've been working for that company for the last 10 years or whatever it is. Okay, it's quite possible that the employer, in order to reward you or entice you to come to work for them or something, will give you an opportunity to purchase past service contribution. In other words, had you been with us all these years, you would have contributed a certain amount of money. And so therefore, we're going to allow you to basically buy those benefits, in other words, that you missed out on. And we as the employer, will also contribute our piece. Or maybe a situation where the employer only will contribute. So when you were listening to the session on RSPs, you probably saw past service pension plan. Then so as you also probably saw pension adjustment, for example, and you wonder, well, where does this pension adjustment come from, and where does past service pension adjustment come from? Where do these two things come from? They come from here. So when you see that there is pension adjustment or past service pension adjustment, and you're wondering, where did all this stuff happen, is the company sponsor obviously has a defined benefit pension plan, and therefore you might say, credits that you didn't have before, so to try to keep up with your pensions and everything. You'll see later when we talk about the sister to this, which is defined contribution, there is no pension adjustment for defined contribution. Okay, so when you look at past service pension adjustment or simply pension adjustment, it refers to where it come from. It came from the defined benefit pension plan. That's where it is. Okay, so the next thing we have to look at is, well, how much money can I get? You're saying to me that when I'm 65 or whatever, I know how much money I'm going to get. That's the beauty of defined benefits. I know how much money I'm going to get at the other end, okay? That's great. How do we come up with these numbers? Okay, well, there's a number of different formulas. And again, you have to look at the plan sponsor, see what formula they're using. Best 3 to 5 years, for example. So in other words, I'm going to look at all the years you worked for me, and I'm going to take your best 3 to 5 years. I'm going to average them out, and then it'll be a percentage of that. Okay, so that makes sure it picks up all your best years, because you might have had, so for example, if you're in a commission-driven type of employment or something, you might have had a very good years, you might have also very bad years, okay? Some years you might have got a big bonus, some other years you have no bonus, So this is kind of interesting, because what happens is they will take all the top, all the peaks, so to speak, of your income over that period of time, of 3 to 5 years of that, and they will then say it's a percentage, 2%, 3% of that. Okay, basically is what we're going to give you for the rest of your life. Okay, the sister to that is career average. In other words, we look at the entire year, all the years you've worked for us, 20 years, whatever it is. We average all that out, and then we'll pay you a percentage of your career average. That's another way of doing it. It could be simply a fixed amount. Okay, I can simply say, look, you work for me, and when you reach 65, you're going to get $4,000 a month. Okay, that's it. There's my number. So as long as you are with me all the way through to age 65, at 65, you can be assured, guaranteed, you're going to get a fixed amount, which is $4,000. That's our deal, basically. So that's another way of doing it. And the last one is what they call a flat benefit, and that is 2% of earnings for every year you work for them, and they add them all up. So you've worked for me for the last 20 years. I take 2% of each year of earnings, add them all up, and here's your benefits. So what we call a flat benefit of 2%. It could be 3%, but most of the times it's 2%. Whichever way you slice all of this, every dime you get will be taxable. Remember that when you're talking about registered money, the adjusted cost basis is always zero. Okay, that's the issue. It's always zero. So therefore, any amounts of money that you derive from these benefits and everything else, they will be T4 RSP, T4 RPP, all that kind of stuff there. So it will be fully taxed. So you need to be aware of that so you can make your appropriate tax planning and everything else around this particular plan. And we'll see you next time.